When it comes to building a portfolio, everybody wants the perfect solution. The one that is just about enough risk, the one that is going to grow as much as possible, the one that's going to take advantage of upcoming trends and hopefully get you to your goals as soon as humanly possible. But put this into Google and you might be looking for quite some time, not least of which because it might sound a little bit too good to be true. But what if I told you that there is one way of building a portfolio that might just answer all of these problems for you and create the perfect portfolio solution? Hi, welcome back to my channel. My name is Zoe and this is Words on Wealth, where I break down key investing and stock market news to make it digestible for you and make investing as simple as it should be. Do make sure you like and subscribe if you're enjoying these videos. I post on a Monday with a market update from the week before and a Friday with thoughts, musings and market takeaways to make your investing journey simpler. Now, the need for a so-called perfect portfolio has always been there. People have consistently been looking for a portfolio construction that allows them to kind of have it all. Some of the most famous ones that we might be aware of are the likes of the 60-40 portfolio construction, which was actually created by John Bogle, the founder of Vanguard. This portfolio construction blends both stocks or equities along with bonds in about a 60%, 40% split. The idea being that this kind of portfolio would be relatively balanced and the bonds, which are generally seen as lower risk, mix with the stocks, which are generally seen as higher risk, to make for a relatively well diversified portfolio that can ride out turbulent times. Now, in recent years, and I've made other YouTube videos about this, the 60-40 portfolio construction has really been called into question. We're in ever-changing times, and the last 5-6 years have really gone to prove that. From a global pandemic to various different points of geopolitical tensions across the globe that have had some funny little outcomes, from high inflation to increasing gold prices to varying sectors recovering at varying speeds and paces. And not least of which, in the background of all this, higher government debt levels than ever, which has put real pressures on the bond market and made them behave in ways that are no longer as they were doing. And as John Bogle, the 60-40 creator, first will have seen and therefore came up with this construction off the back of. In fact, what we're seeing is something in the realm of a K-like recovery, or at least that's what economists are calling it. This is based around the letter K, if you think of the line at the back, and then the two lines, one going directly up and one going directly down. Then quickly transpose them onto some graphs, one of which represents a stock going up or a sector of the stock market going up, and the other which represents it going down. If we think back to COVID, that line going up was firmly in the tech sector, when all we could do was turn to Amazon for our deliveries, Netflix for our entertainment, Peloton for our exercise, and of course the likes of Zoom for work. Meanwhile, the likes of hotel chains, holiday companies and airlines were shooting down. Not only were they languishing in that moment, but also for lots of time over the pandemic, it didn't seem likely that we were going to be able to use them anytime soon either. Now, at the time of recording in 2026, whilst the examples aren't quite so polarised, we're seeing a really similar movement towards some sectors that are doing pretty well and some sectors that are inversely actually doing pretty badly. This is all amongst a backdrop of some severe volatility. So whilst in the COVID pandemic we had some pretty straight lines in the K, now they're a little bit more wobbly, as each and every tweet, or should I say post on Truth Social, sends things absolutely haywire. Now, what all of this means is that people understandably want to both grow their portfolio and allow it to ride out these tough times, whilst also taking advantage and taking opportunity of some of these big moments in the market in which there is money to be made and investments that can be grown. Now, there's a few points along the way in which many investors get it wrong. The first point at which they go wrong is that they only open themselves up to short-term trading events. So they're watching what's happening, chopping and changing in the markets, and their entire investing portfolio is based upon this. Not least of which is this an entirely risky strategy at the best of times, but at the moment, when we've got a totally unpredictable world leader driving a lot of the market movements, it becomes ever more risky. It's also pretty time consuming and can become costly depending on the platform you're using and the trades that you're making. Now, the other way in which people go wrong is that they go for a set and forget method, but I'm all for that. The way that they go wrong with this set and forget method is when they simply do not adjust for the times or do not keep up with their appetite and desires to grow other parts of their portfolio. So hear me out on this one. I really advocate for longer term views within investing and an attitude towards holding into the future. But what that can miss is some of those short to medium term opportunities that many people still want exposure to in their portfolio. And this is where the core satellite portfolio construction method comes in. The core satellite portfolio construction allows for a little bit of both. We have a lovely fairy tale here in the UK, which is all about Goldilocks, looking for just the right thing. And for those who are aware, this is the Goldilocks solution, the just right. It works like this. At the core of your portfolio, which represents around 70 to 90% of your investments, you have a steady away, buy and hold, long-term view. Within that core, you are setting and forgetting. You will be checking in still quarterly and yearly to just have a look at how things are going and rebalance accordingly, but it's very much a on the back burner, doing its thing section of your portfolio. Now, within those satellites, this is where the fun bit comes in. These represent kind of 10 to 30% of your overall portfolio. And they're where you might throw in some of those shorter term, higher risk opportunities. This could be anything from perhaps investing into stocks of companies that you're seeing doing well. It might be investing into the likes of more niche or thematic ETFs. You might be throwing in other assets, the likes of commodities that are a little bit more out there, perhaps certain property or early stage company opportunities. You might also be throwing in even more alternatives, be it investing in the likes of wine, whiskey, art. Really, these satellite sections are for you to take advantage of short-term movements in the market and also to really enjoy and play around with your investments. But here's the beauty of it. Because those satellites only represent 10 to a maximum 30% of your portfolio, you know that the core is doing its job for you. It's sat there, it's ticking away, it's got a suitable risk profile for your appetite, it's doing its thing, working towards your goals. So, if those satellites do really well, fantastic. You've just driven your finances even further and got yourself that little bit closer to your goal. If they don't do so well, not great news, but you've still got the majority of your portfolio in your core, balanced and doing its thing and growing away. There are some really clear benefits to this core satellite portfolio construction. The first being that it offers diversification and stability. It's a little bit of both really, because you've got both those satellites, which might be higher risk, along with that core, which might be more steady away. You've also got both the flexibility to play around with those satellites and take advantage of short-term movements in the market, whilst also having the continuity within the core to really buy and hold and see the long-term growth within major markets. You've got some discipline in there too. And of course, within the core satellite portfolio construction, it's still important not to get too carried away and see something as too much of a good thing, and before you know it, you're away with that trading mentality and potentially not enjoying the long-term benefits of being in the market. But those satellites all allow you some level of potential for outperformance, which many people find really, really appealing. So here's 3 steps then as to how you can build a core satellite portfolio after today's video. First and foremost, get your goal and off the back of that, set your risk profile. Normally what we say as a rule of thumb is that the longer your time horizon, the more risk you can afford to take. So if your goal's 5 years away, we'd normally see that as quite a short time horizon, and therefore your risk might be lower. If it's 10, 15, 20 years away, you can probably afford to take a bit more risk. The next stage is all about building that core. So within that core, you'll likely have low-cost ETFs. You might have a mixture of different assets from stocks, bonds, property and commodities to keep it ticking over and to really perform in the long run. Ideally, you want this core to be something that is a bit of a set and forget section. It's one that you'll check in on quarterly, annually, but you're not going to be making loads of tweaks and changes. And then last but not least, you're adding your satellites. This stage might be more of a process, especially as the research will likely be a little bit more arduous and time intensive. You'll probably be adding things as and when you read them, and indeed as and when they pique your interest. That's the whole idea of this satellite section. If you see a particular company, sector, area that you're like, ooh, that looks interesting, then that's the moment that you can pop it into one of your satellites. So there you have it, the secret behind the just perfect portfolio construction. If you're liking these videos, do make sure to like, subscribe and comment. I'm all ears if you've got any questions about this core satellite method. And I'll see you for the next video. Bye for now.